Welcome to the Tax Roundup for August. This month from the ATO, we're exploring what to do if you have expiring subtrusts and the interaction with Division 7A. Then we're going to take a look at professional sports people and new guidance on personal services income. But most of the activity this month has come from Treasury with the release of a series of exposure drafts based on budget measures. First up, Michael Carruthers is going to take you through the exposure draft measures on limits to the deductions for rental properties and also the removal of the main residence exemption for non-residents and what the implications are. It's quite black and white, so an important one. Then we're also going to take a look at these superannuation measures dealing with first home savers and also downsizers. Across to you, Michael.
Well, Treasury has been busy over the last month releasing a number of pieces of draft legislation relating to measures announced in this year's federal budget, particularly measures relating to housing and tax and super integrity around housing measures. This month we've seen release of draft legislation for the rules around travel expenses for residential rental properties. So confirming that from 1 July 2017, owners of residential rental properties will no longer be able to deduct travel expenses related to those properties, regardless of what the travel relates to, whether it's maintenance, repairs, picking up the rent, doing inspections, whatever it is, basically from 1 July 2017 onwards. No more deductions for those travel costs. Now there are some exceptions to that. For example, if you carry on a business of renting properties, then you can still claim deductions for the travel to the extent it would meet the normal deduction rules. So for those people who may own a number of rental properties and are carrying on a rental property business, those travel expenses can still be deductible as normal. There are also some exceptions for companies, so where companies are incurring travel costs, and also widely held trusts and super funds as well, not self-managed super funds though. So that's the first change. The second one is the changes to depreciation deductions, again, around residential rental properties. And there were some concerns when this was announced in the budget that it might have maybe some unintended impacts on certain areas, and it looks like to a large extent those have been addressed. Basically what happens is that from 1 July 2017 onwards, it won't be possible to claim depreciation deductions on basically second-hand assets that have been acquired from budget night onwards. Now the main concern that was raised around that was, well, what about people buying off-the-plan properties? I mean, someone else has put the kitchen appliances in, you've then bought it off them and now you're using it. Technically those are second-hand assets in your hands. Now the exposure draft legislation deals with that and basically says if you're buying a property as new residential premises, so using some of the GST concepts in this case, and no one else has used those assets or resided in the property, so your typical off-the-plan purchase, then the purchaser, the first purchaser, can still claim depreciation deductions for those assets. But aside from that, it will now be quite difficult to claim depreciation deductions on second-hand assets from 1 July 2017 onwards. The third change relating to housing is the announcement that main residence exemption would no longer be available to non-residents from budget night 2017 onwards. Now the surprise, I guess, in this case, now seeing the draft legislation, is that it's a very black and white application of that rule. If you are a non-resident at the time of the CGT event, and that event happens after budget night 2017, then you do not get the main residence exemption at all. So even if you have held that property for many, many years, and you became a non-resident last week, and now you've entered into a contract to sell that property, you don't get any main residence exemption at all for that property. You'll be taxed in full, and you'll now be taxed at non-resident tax rates, assuming the property is located in Australia. So that is a very black and white rule. There's no apportionment to reflect the fact that you may have been a resident for some or most of that ownership period. On the flip side of that, it means that if you own a property here in Australia and you go overseas, even if you rent it out during that time, you might come back to Australia, become an Australian resident again. You can sell that property now that you're a resident again, and it could potentially be completely tax-free depending on the circumstances. So that distinction between being a resident and non-resident will become incredibly important when it comes to the main residence exemption, the way the rules are drafted at the moment. These are only draft rules. We'll wait and see what happens. Now, those changes could also be quite relevant in deceased estate scenarios as well. And Again, there's some intricacies around those rules that would need to be looked at a little bit further, but those changes can also be quite relevant to situations where someone has inherited a property from an individual who may have been a non-resident at the date of death, for example. Depending on when the property is sold, how long between date of death and the CGT event occurs, who has lived in the property from the date of death onwards, all those things will be relevant in determining the tax outcome, but certainly the rules can be quite different whenever either the deceased individual or the beneficiaries, some of the beneficiaries may be non-residents. So again, we'll need to look at those things now in practice in a lot more detail. Again, waiting for some final legislation. There'll be a little bit of time before we see the final version of the rules. But I guess now that we've seen a bit more detail about where Treasury are heading with this, we can start to think about clients that might be affected by this and planning that could be undertaken. Now, there is a grandfathering provision under those main residence rules that basically says that as long as you held the property on budget night 2017 and you sell the property, you can still apply the main residence rules as they stand. But that does not appear to apply to property bought after budget night 17. So again, there's that limited period for people to maybe have a think about how that might impact on them and maybe take some action if they are keen to ensure that the sale of a main residence or a former main residence can still qualify for that exemption.
Now, continuing with those home saver measures from the budget, Matt Pack is going to take you through the superannuation measures for downsizers and also first home savers.
The government has released an exposure draft for legislation for the first home super saver scheme proposed in the federal budget. The scheme proposes that individuals who have never owned real property in Australia and who are over age 18 may save $15,000 per annum and up to $30,000 in total using their superannuation accounts for tax-effective first home deposit savings. Here's how it works. The First Home Super Saver Scheme will apply to voluntary super contributions of up to $15,000 per year and $30,000 in total made from 1 July 2017. These contributions, along with deemed earnings at the rate of the shortfall interest charge, can be withdrawn for a home deposit from 1 July 2018. Pre-tax contributions are taxed at 15% on the way in. Amounts withdrawn from super under a First Home Super Savers scheme that are attributed to concessional contributions and earnings on contributions will be taxed at a marginal tax rate less a 30% tax offset. Funds would be released from super after applying to the ATO. You would be able to withdraw up to your maximum release amount, which is equal to the sum of your eligible contributions and associated deemed earnings. If you made concessional contributions, such as through salary sacrifice, you would be able to withdraw 85% of those contributions, reflecting the 15% tax in super. You would be able to withdraw 100% of any non-concessional contributions. Individuals would then have 12 months to sign a purchase contract after the savings were released from super. The consultation draft provides that you must occupy the premises as soon as practicable and for at least 6 months of the first 12 months of ownership. The second part of the exposure draft are the downsizing measures for those aged over 65. The government proposes that from 1 July 2018, those aged over 65 who have held a property for more than 10 years will be eligible to make a contribution to super of up to $300,000 from the proceeds of sale of their property. The measure proposes that the property doesn't have to be the main residence for the whole 10-year period, but it must be held by the owner for that time period. As long as the property has been lived in for a partial period, potentially the contribution can be made. The government also proposes that if a couple own a property with only one member on title, both members of the couple may be eligible to make the $300,000 contribution. Importantly, the contribution must come from the proceeds of sale. So that means that if only $250,000 is realised from the sale, only $250,000 can be contributed under the cap. This measure commences from 1 July 2018, so we encourage you to keep an eye on this one as it progresses through Parliament.
From the ATO, we're exploring those expiring sub-trust arrangements and the interaction with Div 7A.
Now, the ATO has released some guidance dealing with expiring sub-trust arrangements and the way that interacts with Division 7A provisions. PCG 2017/13 basically explains what the ATO's view is around sub-trust arrangements that were put in place maybe some years ago in order to avoid Division 7A problems for unpaid trust distributions owed to corporate beneficiaries, and where those initial arrangements are expiring either in the 2017 or 2018 year. Now, the background to this is that many of you would remember that back in 2009, just before Christmas 2009, the ATO changed its view on whether unpaid trust distributions could be treated as loans for Division 7A purposes. Previously, the ATO said that they weren't loans. The ATO changed its mind and said, yes, they can be loans if certain conditions are met. The ATO also explained around that time that one way of preventing an unpaid distribution from being treated as a Division 7A loan was to put a complying sub-trust arrangement in place. And the ATO set out a number of, safe harbour methods to put sub-trust arrangements in place. Now, one of the methods that the ATO said people could use was to basically have an interest-only loan which could cover a 7-year loan term, or in some cases a 10-year loan term. So interest only, but at the end of that period, the full principal amount would have to be paid out in order to kind of meet the conditions under those guidelines. Now, for people who entered into those arrangements, say back around 2010, 2011, those 7-year periods would be expiring nowish, 2017, 2018 income years. And the question is, well, what if those amounts aren't paid out? What if the trust doesn't have the funds or the assets to pay out those full principal balances at the end of that loan term? What are the implications of that? Well, the ATO has confirmed a couple of things. First of all, that if those are not paid out, then basically that would give rise to a loan for Division 7A purposes. So this unpaid amount, which has been treated continuously as an unpaid present entitlement, would now start being treated as a Division 7A loan if that requirement is not met. The good news, though, is the ATO says if it then becomes a loan because the payment has been made in time, the parties could then put a normal Division 7A complying loan agreement in place. 7-year loan term. However, in this case, you wouldn't have an interest-only loan. It would be interest and principal repayments being due each year then until the end of the loan. So what it does means, yes, there's an issue. There may well now be a Division 7A loan if that balance isn't completely paid out. But as I say, the good news is that potentially we can then spread the pain for clients who might then be able to put a normal Division 7A loan agreement in place. Now, we do need to remember that that would mean interest being paid to the company. Company's going to pay tax on that. Have a think about how that's going to come out of the company. Maybe more tax is going to be paid. So you might have actually more tax in the long term being paid under those arrangements. But that's the sort of conversation to have with clients in terms of how we're going to resolve that problem. But at least there is an option. If you don't have the ability to pay it out in full, there is another way around it where, again, over time that can be dealt with in a different way. So that's for those expiring sub-trust arrangements. Presumably the ATO guidance will apply in future years as well. Presumably it's not just for now, it's for now into the future with any expiring sub-trust arrangements.
Now to that new guidance on sports people and personal services income.
This month also sees some guidance released by the ATO that is relevant to professional sports people and how their income and payments are dealt with. Now, a number of years ago, the ATO released an ATO ID which indicated that certain payments made to, in this situation, a related trust of a professional sports person could be split up so that you had some of the payment being treated as personal services income and generally needing to be taxed in the hands of the sports person, whereas other payments potentially could be treated as non-PSI. So opening up the scope to maybe split that income with other people or perhaps have it retained in a corporate structure, for example. Now, the ATO is taking this a step further and in releasing PCG 2017/D11, so it's only draft at this stage, but the ATO has indicated that where an arrangement has been entered into whereby a professional sports person has somehow assigned or licensed certain rights that relate to them into a related company or a trust, that when payments are then made in relation to those rights, for example, the exploitation of their public fame or image, that the ATO has given us some safe harbour guidelines on how we might split the payments up. And basically what the ATO has set out is a 10% rule. So up to 10% of payments being made under a contract with a sporting club, for example, Where the payment relates to, in part, exploitation of public fame or image, the ATO says, well, up to 10% of that total payment, or those total payments over a period of time, can be treated as basically income from the exploitation of those rights, which should not be treated as personal services income, and therefore opens up the possibility of either retaining income in a company or maybe splitting that income, distributing it to other beneficiaries other than the professional sports person. Now, there's a couple of things here that are pretty important to remember. First of all, that related company or trust needs to hold those rights. So unless a sports person has taken some action already to shift those rights into the company or trust, then this PCG is not really all that relevant to them because they'd be receiving all those payments personally anyway. The second thing is need to ensure that payments that are being made to them do actually take into account those rights. So those rights are covered by the payments that are being made. So there's a few things to check if you have clients who might potentially fall within that category and who could potentially make use of this. Now, the other thing to remember is the 10% is really a safe harbour guide from the ATO. The ATO is saying, look, if it doesn't exceed 10%, probably not going to take a whole lot of compliance action to dig into the detail. The ATO recognises how hard it would be to split payments into various components and figure out how much that payment relates to these rights. But certainly if clients want to kind of stay under the ATO radar, this provides a way of them doing that. For those clients who perhaps want to be a little bit more aggressive and argue that payments or the portion of the payment relating to those particular rights is greater than that, look, they're free to do that, but they would need to be able to back that up and support that with something. And that's where things might get a little bit more difficult and harder to evidence. But that option is there if people want to take it.
And that's the tax roundup for this month. Members of Knowledge Shop, remember that you can download the year-end standards that you need to manage all those tax returns and other materials, plus also the full self-managed super fund audit program is available now for download. If you're not a member of Knowledge Shop as yet and you want access to those work papers to manage all the things that are coming through right now, then give Julie a call on 1800 800 232 or take a look at the website. We look forward to talking to you next month. See you soon.